Markets expected to be up 200 points right at the open. Joining us right now to talk more about investing today is Charles Schwab's Chief Investment Strategist, Lizanne Sonders. Lizanne, always great to see you. Thanks for joining us.
Hi, Maria. Good morning.
Well, we began the earnings season pretty good. We had three Dow components this morning reporting better than expected numbers. And overall, we're looking for growth in profits for the S&P 500 of 19.5%. Will we get there? Is that what you are expecting to drive markets, earnings?
So we don't formally publish earnings forecasts. I think the best guess is that if there is a bias in one direction or another, companies were probably maybe on the more cautious side when giving guidance last quarter. So the hope is that we shouldn't have too much trouble. I do think, though, that much as was the case last quarter, I think forward guidance, not only in terms of what the ongoing implications are from tax reform, but then, of course, more recently, what's going on with trade. And I think analysts are going to be focused more on what companies say about the rest of the year, more so even than what's happening this quarter.
Lizanne, it's Kevin Kelly, and I think you're bringing up one of the most salient points, and it's what companies' managements are going to say for guidance for the rest of the year. And one of the things that I'm worried about is where are we going to be on a 10-year Treasury? Volatility picked up at the beginning of this year because people were worried about the 10-year going above 3%, 3.5%, 3.25%. So how do you think that's going to impact guidance going forward, and where are we going to end the year in regards to basically where the 10-year Treasury is going to be and the Fed raising rates?
Yeah, so I think it's important for a lot of reasons, not least, of course, for the financial companies. And it's not just the yield on the 10-year, but, of course, the yield spread. So I think that will be a factor as well. It also matters in terms of valuations because it's kind of a bell-shaped curve when it comes to interest rates and inflation and valuations. We've been in a bit of a sweet spot with not only the 10-year where it is, but inflation and inflation expectations where it is. Those start to tick up. You start to have to ratchet down valuations by virtue of the relationship between the two. So I do think it's something to be mindful of in this earnings season. The other thing I would say that's important is when we were going through some of the most concerning aspects of the disputes back and forth in trade, we were in a quiet period with companies. We were not only in a quiet period in terms of what they could say, they were also in a blackout period in terms of buybacks. So I think that was a vacuum that was there during the most tumultuous era from a tariff standpoint on the market.
Yeah, that's a good point. And actually, that's a point you brought up, Kevin, weeks ago about that. And it was a really good one because now that we're out of that period, we see money moving back into stocks and companies buying stock in the open market. Listen, let me ask you this, because a couple of guests have come on the show recently and said the biggest threat to markets right now is the Federal Reserve. And the biggest threat to the economy growing and accelerating is the Federal Reserve. Whether they're going to mess up in terms of the wind down of the $4.5 trillion balance sheet or perhaps raise interest rates too many times in an environment that, things look good, but it's still fragile. Your take?
Well, even if they don't mess up, however one defines that, we are now in an era of tighter financial conditions. Now, that's very distinct from where we've been in the last couple of years. So when the Fed began raising interest rates in December of 2015, financial conditions had actually tightened leading into that. But since that point, they actually had been loosening until very recently. And the initial trigger of tighter financial conditions was driven by equity market volatility. But then you saw what happened in credit spreads. And then at the same time, they've gone from QE to QT. So we're unquestionably in an environment of tighter monetary policy. That doesn't automatically jam you into the next recession or cause major problems in the market, but it does tend to bring in an era of higher volatility. That was our view in 2017 at the very end of the year when we wrote our 2018 outlook, that we felt we were later in the cycle, that financial conditions would tighten, that the Fed would become at least mildly more aggressive. And as a result, you would likely get more pullbacks, greater frequency of pullbacks, a bigger drawdown, and higher volatility. And obviously, so far, that's what we've seen.
So you still like stocks here, even though we are going to see a more volatile story?
I think this is still an ongoing secular bull market, but we're at a stage that is going to be much more ripe with volatility. And you could have made that assessment even just simply looking at last year's lack of volatility. When you look at maximum drawdown of only 3%, only 1 year had less of a maximum drawdown in 1995. Every year, if you look at the top 10, the top 15 years of low volatility as measured by that metric, every year thereafter, you saw much greater drawdowns, greater frequency of pullbacks, higher percentage of big move days, 1%, 2% kind of days. So much higher volatility. So even absent late cycle views, higher inflation, tighter monetary policy, just the lack of volatility last year suggested we were likely to see a pickup this year. So I think, again, later stages, but I don't think we're at the end of the bull market. I think the next true bear market will come when the market starts to sniff out their next recession. I think we still have some runway ahead of us before we have to start to worry about that.
All right, we'll be watching that. Liz Ann, great to see you. Thanks so much.
Thanks, Maria.
Liz Ann Sonders, Charles Schwab there.